to another issue of Ask the Expert. In this month's podcast, Momentum's Glyn Owen and James Clemster look at the market impact of the US's third quarter results against a background of mixed macroeconomic data from the developed world, as well as continued signs of weakness from China. In Mondial News, we're delighted to be preparing for our 2012 Client Insight Seminar to be held in November. We'll be welcoming James to Dubai as one of our panel speakers, giving you the opportunity to pose your questions to the expert personally. Look out for your invitations, which will be arriving shortly, and also check for details of the seminar on the events section of the website. Have a great month.
Glyn, September turned out to be another pretty good month for risk assets. What was going on beneath the surface?
Yes, it was I think a better month for risk assets than most people expected. In broad terms, global equities, developed market equities were up just under 3%, very good month. Global emerging market equities were up by 6%. Credit did well. The peripheral bond markets of Europe did particularly well. So it was, frankly, a much better month, I think, than anybody anticipated. And the key reason was something we talked about in our podcast a month ago. These big meetings of the central banks coming up, the European Central Bank and the Fed. Not only did they deliver on their promises, but they actually exceeded expectations. So it was a very important month for markets and an extremely good reaction from markets from the central bank meetings.
Central banks clearly the driving factor behind the month's returns. Let's start with Europe, shall we? What was the main count?
Yes, well, interestingly, European bond markets, peripheral bond markets, and European equities have been performing well since Draghi's now quite famous speech in London towards the end of July, where he said the ECB will do whatever it takes to preserve the euro. Now, of course, the market has been speculating on what that actually means in practice, and they've been waiting for this meeting to happen on September the 6th, waiting for the meeting of the European Central Bank actually to flesh out their plans to preserve the euro. And in fact, what they committed to was a program of outright monetary transactions, as they call it, OMT, under which they will buy unlimited amounts of government debt from distressed Eurozone member countries. Maturity is 1 to 3 years, with conditionality attached. In other words, they will buy those bonds subject to the government in country concerned applying for a rescue bailout from one of the Eurozone rescue mechanisms. So it was actually a clever move, I think, that effectively committed to pump priming on an unlimited basis. And remember, the ECB is the only institution in Europe that can do this. It can print money, but on condition that the country concerned will actually apply for a bailout and therefore will have conditions attached regarding its fiscal policy, reform programs and so on and so forth. So cleverly, Draghi, the president of the ECB, carried the Germans, who had been reluctant to go down this route, carried the Germans with him and got their full support at political level. So I think it was a really very important move, the ECB move. And of course it's resulted in a big move in share prices in Europe, in an outstanding performance over the past 3 months, and also in the yields on peripheral government bond markets. To give you an example, Spanish bond yields, 10-year bond yields, 7.5% 3 months ago, fell directly after the ECB announcement to 5.5% and have hovered around that since then. Italian yields have gone from 6.6 to about 5. Big moves. Greek bonds, incidentally, have gone from 27% to 18%, but let's not get too excited about that. You can't buy them.
Elsewhere, the US wasn't to be outdone.
No, again, we've been waiting for the Federal Reserve meeting in the middle of September after Bernanke's Jackson Hole speech, which we referred to a month ago. Again, in the event, there's no doubt that Bernanke surprised on the upside. What he's done is committed to an open-ended program. It's the first time they've gone to an open-ended program of buying mortgage-backed securities, so agency bonds, at the rate of $40 billion a month until there is a substantial improvement in the labour market. So he's actually linked the monetary easing program, and this is QE3, the third round of quantitative easing, he's linked it to the labour market, which is the first time that has happened. It's an intriguing move, and he's made it very clear there has to be, in the Fed's words, a substantial improvement in the labour market before they'll ease back on this monetary printing. So it's a huge commitment. At the same time, they've committed to keeping interest rates at these very, very low levels, virtually zero levels, until mid-2015 at the earliest, so they've extended that period a further year. And they're continuing with Operation Twist, which is extending the maturity program of the bonds that they buy. So really very big moves indeed, and a lot of liquidity that will be pumped into the system as a result of this. Again, exceeding market expectations by quite a margin. So again, a good reaction to that from markets.
And against this backdrop, interesting news on the macro side in developed markets as well.
Well, I suppose you could say there might be something of a disconnect, because of course what we now have is very, very loose monetary policy, which we have been talking about for a long time. It's now obvious that's going to continue for a long time to come. The ECB having said that they will effectively bail out Eurozone member countries, providing they seek a formal bailout. So again, a really big move, and I think has bought a lot of time for politicians, but all of this monetary easing is not yet feeding through into the real economy. So you've got lots of liquidity being created, but the real economy remains pretty flat. And in the Eurozone it's in recession. UK is pretty much flat. Japan is flat. US is growing at about 1.5% or so. So levels of growth that are significantly lower than earlier this year, but look as if they are probably stabilising around these sorts of levels. And I think the key thing is that both the private sector throughout the developed world, and we know the government sector, has got to go through a long programme of balance sheet repair, increasing savings, reducing spending, and of course the injections of liquidity are to help to offset that. But I think we're in for a long, long period of pretty slow growth in the developed world and very loose monetary policy.
Talking of slow growth or slowing growth, China also.
Yes, China we have been concerned about all year. We've talked about it at many of these monthly sessions, and there's no evidence to suggest that this slowdown in the Chinese economy is reversing. We know the issues. China has been heavily dependent for its growth on investment spending. That's clearly slowed down a lot. And on exports, they have obviously slowed down a lot because of the slowdown in global growth. And the Chinese authorities have not yet really reacted in any meaningful sense to this quite material slowdown. You can't necessarily trust the official figures from China, but what you can trust is the prices of commodities, and of course they're fallen quite a long way in the commodities in particular that China's been buying a lot of. Iron ore is a good example. They've fallen a long way, so there's clearly reduced demand. I think we have to wait until the leadership change happens in China. That's going to happen probably this month, in October. And we then will expect to see some action to help to stimulate the economy, but there's nothing the Chinese can do about this global slowdown, and the global slowdown is here. It's going to carry on at a pretty slow pace for quite some time. So yes, China, I think we're seeing a structural slowdown in growth.
Okay. You mentioned the impact on commodities. Oil's obviously moved as well recently.
Yes, the oil price actually was strong in the previous few months. It actually fell a little bit in September, which I thought was encouraging. The fall was triggered mostly by news of increased production levels in the US, high levels of inventory, and importantly, Saudi Arabia committing to increased supplies to offset the impact of the sanctions on Iran, which is clearly beginning to bite, both in terms of supplies of oil and indeed within Iran. We've seen their currency fall dramatically in the past week or two. So I think it's encouraging to see the oil price fall. I think given this slowdown in global growth, I would expect to see the oil price come off further, but of course there are risks, as we well know, in the Middle East. This recent escalation in the conflict between Syria and Turkey is obviously not helpful for the oil price. So we're mindful of the geopolitical risks, but if you look at simply the economic fundamentals, the oil price should be quite a bit lower than where it is today. Now that would be unambiguously good news. It would be like a tax cut to consumers.
Turning back to the markets then, we've had 4 positive months on equities now. How's valuations looking?
Well, clearly markets are no longer as attractive as they were 4 months ago. Markets from the lows in June are up about 15%. Both the MSCI World Index and the Global Emerging Market Index. Peripheral Europe is up by quite a bit more than that incidentally, but generally speaking markets are up 15%, so valuations not as compelling as they were. we've got this slowdown in growth, stabilising now, and some pockets I think are actually beginning to look quite interesting. The US housing market we've talked about before is certainly still improving, and I think will continue to do so. So let's not get too bearish about the economy, but it's going to be slow growth for quite a period. And I think that there needs to be something of a catch-up between this liquidity boost to markets and the underlying economic fundamentals. So I think we'll see some period of consolidation here, and let's be aware of the risks still. Yes, there's been very important and positive action by the central banks, but we still have to see peripheral Europe apply for a bailout. And I'm thinking Spain in particular is still sitting on its hands. It's trying to avoid a bailout because, of course, that's politically very damaging to them. So the market is waiting for that. I think we're going to see a fair bit of nervousness as a result of that. And, of course, then we've got a big issue in the United States. Early November, we've got the presidential election. It probably doesn't matter too much who wins, and it's looking as if Obama will win. But the big issue is that the fiscal cliff has to be addressed immediately after the election. Because on current legislation, there will be tax increases and spending cuts, which would take about 5% out of the economy next year. That's clearly not going to happen. There'll be some compromise with that, but nevertheless, through that sort of negotiation period between the President, the new President and Congress, it's clearly going to be a nervous period. So I think we've got a few hurdles still to overcome, and together with this point you made that valuations have obviously been extended as a result of the move in markets, then I think we'll see markets consolidate for a period. But underpinning all of this is this huge liquidity. I really can't see markets going down very far with this huge liquidity underpinning and a gradual, steady move away out of this sort of problem of too much debt that we've had. Remember, gradually, balance sheets are being repaired. It's a multi-year process, but it is underway.
Brilliant. Thanks, Glenn.